Hi, this is Leah. I'm from SPA Gippsland, and I have Abe from Phillipsons here with me, and we're going to be talking about some taxation in regards to investment properties. So, hi Abe, how you doing?
Hey Leah, thanks for having me for starters. And yeah, as you said, I'm an accountant. So talking all things tax, which may or may not excite some people, but I've attached a bit of a presentation to go along with today's little workshop. So hopefully we can all get something out of it. Leah, I'd like you to jump in if you've got any questions or if you see common themes coming from tenants that you work with in regards to taxation or anything financial, and we'll try and share as much information as we can to make this little workshop useful. So what I'm going to do is just share my screen here, and Leah, just confirm you can see that there.
Yeah, definitely.
Fantastic. So essentially, I suppose where we start is rental income. And as we all know, that's generally what we pay someone like Leah or an agent to do to collect the income. They draw the lease agreement and make that as smooth as possible. So as an owner or of an investment property, what we want to do is actually have that income coming into our bank account, whether it's fortnightly or monthly. We can negotiate those terms, but with as little hassle as possible. So the key is to generate as much income as possible to help pay for that investment and use that to either pay down debt, go on and buy another investment property, or use that for your own discretionary spending as such. So that's pretty straightforward from the income point of view of what you do with an investment property and generate income. And like I said, your agent, such as Leah, can really help with that point of view. The next element to that is expenses. So this is where we get a little bit more in depth as such. So like I said, income's pretty easy. It's what's deposited into your bank account and what the tenant pays you. The expenses, as you can see on this, is pretty broad. So, and when we talk about expenses, I suppose purely with an accountant, you're looking for as many expenses as possible to reduce your taxation. So claiming things is anywhere from advertising, as you can see on that list, down to the bottom, to repairs. And you want to be always thinking about keeping receipts, or if you have a repair job and then you've got to buy some screws or pay a plumber to do the job, making sure we claim the maximum that we can in that regard, because it does, I suppose, offset your income and essentially creates a better tax result for you. So to get you all thinking, it is important that we understand what the expenses are we can claim on a rental property. And this is what will go into your tax return, and the accountant will prepare on your behalf, or if you're preparing your own return, this is what you're looking out for. So advertising for tenants, if we're obviously putting ads in the paper or paying an agent to do so, that's obviously deductible. Body corporate fees, which is similar to insurance in a way, which I'll touch on, but body corporate fees are more for units and townhouse type agreements, so that we can actually have public liability insurance and strata titles and everything else. So that's a pretty important one, and they're generally sort of $500 a year upwards from there, and that will contain insurance within that too. Cleaning, if you had to pay for carpet cleaning or any form of cleaning, is obviously an operational cost, so we can deduct that one. Council and water rates are pretty self-explanatory, but it's probably important to point out to those of you who are looking at perhaps buying an investment property that yes, you are still liable for the council and water rates. Now, the tenant will go ahead and pay the usage of water, but you've got to pay connection fees. So there's still a cost there, which you've got to have in the back of your mind if you're budgeting or you're trying to look into buying a property, and council rates, that will fall with you as the owner to pay those rates. It's not back on the tenant. So that's just one to be mindful of. Depreciation, it may be foreign to some people. Leah did a little presentation with some quantity surveyors just last week. So I think tuning to that one, and that will explain that further. Us as accountants would appreciate your assets. But when you're buying a property, I suppose the quantity surveyors are the best position to comment on that and value the assets. Electricity and gas, generally that will be the tenant's cost, but you may, for whatever reason, have been doing some maintenance on it or had no tenant in there at a point in time. So if you've had those connected, they may be deductible in that case. Gardening and lawn mowing, pretty self-explanatory from that point of view. Insurances, again, we've got to pay insurance on any asset to have some coverage, but there are a couple of insurance policies, whether it be public liability. So that's just making sure that you're covered if someone enters your property or breaks a leg on your property. It sort of covers you from that point of view. Landlord insurance is a really good one, in the sense that if your tenant defaults on rent or put holes in the walls and things like that, and you can't make a claim on it, or they do a runner and you never see them again, you've got some coverage. And building and contents is highly important. Your asset is a huge value, and you want to make sure that if it burns down or something untoward happens, you've got coverage on that point of view. It's all well and good to have a $400,000 property, of which half of it could be the land value, but if something had happened to the bricks and mortar, you want to make sure you've got coverage there to replace that in the event of something untoward. Big ticket item in all of this is the interest on your loan. So if you go out and fund a property, you want to make sure you're claiming that interest back, because you look at an average property with interest rate of 4% as an example. On a $200,000 loan, there's $8,000 of loan interest that is deductible to you to come off your rental income and reduce the profit on that, and essentially reduce the tax that we pay, or create a bigger refund in that case. So ensuring we have things like loan statements or interest summaries at the year end when we're producing our tax or giving that to our accountant is extremely important and not to be overlooked. Land tax, I won't go too hard into that one because there's some thresholds around that, but some properties, if they're over a certain value, will attract land tax, completely tax deductible. There might be some legal expenses, whether it's drawing up lease agreements or fighting against the tenant for whatever reason. You might have to have incurred some legal costs, so they are deductible. If it was to do with legal costs in purchasing or selling a property, they'd be capitalised. And when I say capitalised, that just means that they'd be added onto the cost base of the property, and we deal with the, in a roundabout sort of way, we get the deduction when we calculate capital gains tax. So that would be sort of deferred and sit there until a future point in time. Ongoing pest control. So if you have the property sprayed, or you've got rodents or termites or any of those sort of problems, they're deductible expenses once we've acquired the property, not so much beforehand. Property agent fees and commissions, similar to the advertising I touched on earlier, to ensure we've got regular income when we're collecting it. It's well and truly worthwhile paying your agent to streamline that. It takes the stress out of investing, and if you're looking to that investor model, you don't want to be running, you don't want to be an agent yourself, essentially, so we can claim their fees. Quantity surveyor fees, again, Lia had a previous session with BMT which goes on to explain what it is they are and what they do, but their fees are most certainly deductible. And repairs and maintenance, so that's another one. Electricians, plumbers, builders, genuine repairs to the property or maintenance are deductible, which I'll expand on a little bit in a minute. So there's probably three definitions under repairs and capital type expenditure, which we need to be a bit careful on to make sure we get the best tax outcome. So repairs, as it says there, are costs that we can deduct from our income immediately. So get the full tax benefit straight up. Now, generally that is work that I suppose fixes a problem or restores an asset to its original use. So if we had a rotted decking board as an example, and we had to pull a couple of them up to replace them and make sure that someone doesn't put their foot through them, providing we're using the same material to put them back down, that would be deemed as a repair. Things like painting the property, it's repainting it to reinstate it to its original condition. So we get to repair them and claim them as a deduction against our income. Not to be, I suppose, mixed up with capital expenditure, which gets a bit more technical, but a capital expenditure are costs that can't be claimed immediately. So you could go and spend $10,000 on a new pergola, for instance. It doesn't mean you get a $10,000 deduction against your taxable income. What it means is you, in that instance, you get a deduction on an asset over a number of years, and the ATO have what's called an effective life. So there's two examples there. If you got new carpet, you'd be eligible to deduct that over 10 years. And likewise, if it was something like an oven, it's assessed at 12 years. So just because you spend $1,000 on carpet in a room doesn't mean you get the $1,000 tax deduction like you would in a repair instance. You'd actually have to write that off on average at about $100 a year. So you're not getting bang for buck from a tax point of view, but yes, you still do get that tax deduction over a period of time. So just be mindful of that. On top of that, there's capital works deductions. So they're really focused on the building costs of your investment. So when we talk about building costs, we're talking about roofs and building structures and bricks and mortar, which are really attached to the property. They don't give us a huge tax advantage, but quantity surveyors can most definitely value those items, and we get them deducted over 40 years. So you think about a property that's got $100,000 worth of building costs to it. That's excluding the land, excluding the fit out, so air cons and carpet and everything else. You're still going to get 2.5% per year on that. So that's $2,500 a year in this example over 40 years. That would give you a $100,000 deduction on that property. So it's not all up front like a repair bill is. It's actually depreciated over an extended period of time. So that's one to be mindful of, and it's pretty important we understand how repairs are worded as to how we get the tax deductibility against them. Again, quantity surveyors plays hand in hand with the items I've just spoken about, and I don't think there's a huge need for me to go into great detail about this. Some rules have changed, which obviously us as accountants are around, and quantity surveyors are most certainly around the list of how we can depreciate assets from that point. But it is a worthwhile exercise. If you buy a new property, well and truly get a quantity surveyor involved. There'll be some serious depreciation to help you along. On the other hand, if it's a second-hand property, there may be ability to use a quantity surveyor, but I suppose the ATO legislation on that's probably reduced the eligibility and I suppose the tax advantages with all of that. So again, probably just refer back to last week's interview with BMT quantity surveyors, and that will give some more information around that. Capital gains tax. So this is more the end of the property's life as an investment purpose that we look to sell. Obviously, there's a capital gains issue. So it's all well and good to earn revenue and deduct our costs against it as we go. But capital gains deals with the income or the gain, or could be a loss in some circumstances on a property that you've held for a period of time. So if you let's use simple numbers here. If you bought a property for say $100,000 and 10 years later you're lucky enough to sell it for $150,000, you can see in that example there's actually a $50,000 gain in that example because there's appreciation in the property value. So the ATO would say, come along, let's pay tax on $50,000 because you've made income on that. So there are some discounts that we get. We get a general discount if we've owned a property for longer than 12 months. Which is nice of the ATO, but that would only reduce the gain in this instance to $25,000. So be mindful of that when planning or selling a property of your own income position, because if you're coming into retirement but you're on a really good wage, and let's say you're on a $60,000 wage somewhere, it may make more sense to hold off on the sale of that property until next year or a future year when retirement comes, because you may actually not have a huge amount of income. So I'm just talking that example was a $25,000 capital gain. It may make more sense to pay that when there's no income, rather than when you're on $60,000 of wages, which would create your income to be $85,000 and you pay tax at your marginal rate at 32.5% in that example. So it's about deferring that and about timing that too to suit your needs and manage the tax accordingly. So one to be mindful of when planning around selling a property, if that's you. Likewise, it could be a capital loss, but if you bought a property and sold it for less than what you purchased it for, unfortunately, capital losses can't be offset against your actual income, so wage income or business income. They can only be offset against other capital gains or capital losses. So you've got to be mindful of that too. With all of this, I suppose the ATO, some people call them Big Brother. They've got a lot of data on you, and they get better every year. So they talk with people, other government organisations. They talk with the State Revenue Office, so they know that you've bought a property previously. They know when you've sold it. They know what your income is. They know what your dividends and your interest are. They've got a lot of data on that. So just one slip up, or you may forget to report something in your tax return. Chances are they'll send a letter and say, have you reported all your income, or we believe you should pay tax on this amount. So just be mindful of that. And as a result, you must keep records for 5 years. So whether that's receipts for repairs on the investment property, whether it's the income statement, those sort of things are all pretty important. So keep them for 5 years. And it's not 5 years from, I suppose, the start of the financial year. It's 5 years from your notice of assessment period. So that's when you lodge your return and it's processed by the ATO. So if you're a late lodger, if you've lodged your tax return 2 years late, well, it's 5 years from then. So that's really 7 years from the date of the tax return, essentially. So pretty important to keep them. There's plenty of ways and means to keep your records. You don't have to keep the originals. It's obviously an option. The risk with that is they can fade, they can get lost, they can go anywhere. So it is your responsibility to keep them. There is, I suppose, apps and add-ons and all the rest of it to actually scan them or store them electronically. So there's nothing to say you've got to have the original paper copy. You can have it stored electronically. You've just got to be able to produce that. It could even be a photo. You just got to be able to produce that if you ever do get an audit. That's the main thing. And again, the ATO probably works different to, I suppose, the rest of the Australian legal system in that with the ATO, unfortunately, you're guilty until you can prove you're innocent, unlike the rest of our system where you're innocent all along until they can prove you're guilty. So if they're not happy with what you've reported, they could issue you with an assessment to say you owe us X amount of tax because we don't believe what you've reported. So evidence is highly important, hence the reason there's a requirement to keep records. So that's probably touched on a crash course in what the income expense components, what happens at the end of an investment property with capital gains, and what we need to do to keep receipts and all the rest of it to stay in the good books of the ATO. I suppose what I want to have a bit of a chat about now is how we structure our investment properties and making sure that we set them up right from the get-go and a bit more strategic thinking. I suppose taxation can be a bit historical in nature and a bit transactional sometimes. So let's focus on being a bit more proactive about it and making sure we get the right advice from the get-go to put us in a good position moving forward, because that's the goal of what an investment property is generally set up for. So this touches on good debt versus bad debt, which may not have heard that before. Most people would probably say all debt's bad, or some people say debt's fantastic. You can leverage off it to go and buy nice shiny things. But essentially, in my view, there's good and there's bad. With the fact that good debt is something that will give you a return or grow in value. So the example there is to take out a help loan or a student loan to pay for education. To me, that's good debt, because you might go and get a 30 grand loan, but it gives the ability to get an engineering degree, for example, and go out and earn $100,000 a year. So that's paid for itself 10 times over in that case. Good debt is an investment property. You buy $200,000 property and hope that one day it's worth $400,000 and you generate a return on and capital growth along the way. So that's probably some examples of good debt. And obviously with an investment property, you get the interest deductibility from a tax deduction point of view too. So that helps generate some bigger tax refunds if we can negatively gear it or reduce the tax payable depending on the individual circumstances. So that's a bit about good debt. Bad debt's probably more focused on personal debt, I suppose you could say. So if that's you, that you feel like you've got credit card debt or some personal loans, try and focus on paying them off, essentially, because you pay some pretty high rates of interest on them, and it's not unusual that some of those get up to 20%, which is a pretty scary number considering our official cash rates nearly down to zero. So if you're in that position, my focus would be just to pay off as much as that perceived bad debt as possible, because it's holding you back, it's reducing your cash flow, and you can't create wealth while that's there. So if you've got a choice to pay off, let's say, a credit card debt and a investment property loan, I'd be doing everything I could to pay off that credit card debt, because first and foremost, you don't get any tax advantage on the interest, so you're not getting a tax deduction on that, whereas at least the investment property loan you are, so there's a bit of a tax benefit there too. And in investment property loan, you're probably paying somewhere between 3 and 4% to the bank, whereas a credit card debt is going to be double digits up to sort of 20% in some situations. So that's a bit about those debts and trying to leverage, I suppose, out of those and make sure you're getting the most bang for buck from a tax point of view, but also from an investment return point of view too. There's all sorts of investment options, and while we're here talking with Lia, it's obviously the focus is on real estate and returns. But for those of you entering the investment market and thinking, what do I want to do? Do I want to buy property, or I don't have a huge risk appetite, I'm happy to sit in the bank? I think you've got to understand diversification and the options out there to help make a decision, which is this strategic thinking to try and set you up for the future. So if you've got 100 grand, you could go and put it in the bank, but they're going to probably give you somewhere around 1% per year. So if you're happy with that and you don't want to lose your capital or chew into it, yeah, that might be a great option for you. It's not for everyone, but for some people who are retired and they don't want any risk profile and they want to make sure they don't chew into their capital investment, it's always a popular option. Real estate can generate much higher returns. So, while we're talking here, let's use 4 or 5% as an average, because I think that's pretty fair. And real estate's deemed pretty low risk as well, because it's bricks and mortar. History suggests property values realistically go up. I'm not saying that they'll always go up by any means, but that's what history suggests. So it's a good base to work with. They've been a solid long-term investment along the way, which probably helps, because real estate's not cheap to get into. Stamp duty and legal costs to get into a property probably cost you about 5% here in Victoria of the overall cost of the property. So it's a pretty high cost to get in. And likewise, when you want to get out, you're paying an agent around 2% to sell that for you for the price you're asking or trying to receive. So there's a bit of a cost to buy into the real estate market and exit out. But again, it's deemed relatively safe, and it can generate some bigger returns, essentially. Obviously more risk to it than the bank, but that's why the return's higher. The next step there is shares. So that's entering the share market. And again, as we've seen recently, that can be up and down, much riskier asset. And again, the higher the risk with an asset or an investment, obviously the higher the return can be. So the dividends can return 6 to 8% higher or lower in some cases, but let's use that as the average. So there's obviously potential to put $100,000 into an exercise like that. But tomorrow you could wake up and that $100,000 could be worth $120,000, or likewise it could be worth $80,000. So I suppose your risk profile will help determine whether you're happy to do that and run that sort of a risk. Again, the other one is businesses, which can vary greatly. They can generate huge returns, or they can make no money too. There's a huge level of risk with a business, but again, that can be more of a personal choice type position where you want to build your own business. You don't want to work for someone else, or you want to build an enterprise and pass that on to the next generation. There's all sorts of ideas and opportunities within business, but that probably points out some key investment options to make you think about it a little bit, and the returns that can be associated with those too, to have a think about. Am I young? Do I want to go out there and risk it all, or am I a bit more conservative, or am I somewhere in between? Everyone's got different profiles, so I can't answer what your individual risk profile is, but I think it's good to start thinking about it, because it'll help you, if you can understand then, determine where you want to invest your money if that's the path you're going down. This one here is a bit of a table, and there's a bit to it, but I think it's pretty important when looking to invest in anything, you do your due diligence. So whether that's talking with an accountant, a real estate agent, family members, friends, a financial planner, a bank manager, it doesn't matter. In essence, it's probably nice to speak to as many of them as possible when doing this analysis to make sure that, if you're going to go and buy a $300,000 asset, you probably want to be sure it's the right thing to do and you've done your due diligence. So this is a really good example of something that I would do for an investor or a client, myself, looking to buy a property. And the reason I've done this with a $300,000 property value is it's probably an average price here where we are, and it's affordable. So the numbers show that there's, the investor here is buying a $300,000 property, and they've said, right, let's put a 10% deposit down. Now, again, if you want to avoid lender's mortgage insurance and those sort of things, speak with your bank manager. But essentially, you generally need a 20% deposit type exercise and have that within the property so that you're not paying all these extra costs. But let's just assume for the sake of this exercise, they've got some security in a principal place of residence or another house somewhere else, that the bank's not going to charge lender's mortgage insurance. It's just purely the investor approach. Set it up as a 30-year loan, which is really common at 4% interest. It's probably a bit high in the current market, but let's just assume 4% because it's a round number. So we've gone out, we've done a bit of research, said, we think we can get a property with a 5% return. So fantastic. We're going to get $15,000 a year. Obviously, as we touched on before, obviously our operating costs to come out of that is everything listed below. So focus on that left-hand column, which is deemed as tax. This is what I would look at as an accountant to say, okay, you've got this property, you've derived $15,000 of income, and then there you've got $18,800 of expenses, which you can see the big ticket item in all of that is the loan interest. So we're paying 4% on a $270,000 loan, which is the main contribution to deriving a loss on that property. There's another line item there of $3,000 depreciation because I went and got a quantity surveyor to actually depreciate the assets in the property. Although it's not a cost, I haven't had to physically go out and pay $3,000 for anything. It's just, I suppose, an accounting entry that we're allowed to depreciate. So we get a deduction on it. So the reality is I actually run that at a tax loss of $3,800. Doesn't sound that dramatic, but it will help me obtain a tax deduction and offset that against my marginal tax rate. So how that works is $3,800, assuming my marginal tax rate is 25%, I'd actually save $950 tax in that exercise. So you can see how an investment property can actually help grow a little bit more value in the whole exercise and put some money back in your pocket through the tax system. Probably let's not just focus on tax here though, because it's all well and good to say it's negatively geared and I get a bit of an extra tax refund on it. But in reality, I'd prefer to make money on a property and pay tax, because it means if you go out there and make $1,000 on a property and you've got to pay 25% tax, well, $250 tax isn't huge, but at the end of the day, I've got $750 left in my pocket to spend or to reinvest. So that to me is a better result. But again, we've got to compare the tax outcomes and the cash flow outcomes. So that second column there just shows the exact same numbers, but this is what we physically bleed from a cash point of view. So you can see down there in depreciation, we don't actually bleed any cash there because depreciation is not a cash item or a cash expense. I've stripped out interest because we don't really physically pay interest. What we do is generally on loans, we pay principal and interest. So it's a higher number. It's actually $15,000. So in this exercise, you can see tax and cash flow, there's a discrepancy. If I wanted to go out and fund that property, it would actually cost me $5,500 a year to fund the property. Obviously, yes, I get a bit of tax benefit on that. So I'm actually out of pocket $4,500 for the year. So cash flow wise, if you broke that up on a weekly basis, that property would cost you $87 a week. So I think that's a really good way to answer the question, can I afford this investment? If you can afford $87 a week within your budget, then yes, you can. I'd probably have a bit more of a buffer in case the hot water service blew up or something similar. You've got some savings there. But if you can't, if your budget's $50 a week, that probably breaks it up to say, no, this exercise we're not ready to go for yet, or we've got to make some other sacrifices somewhere. So purely focusing on something from a tax position probably isn't a sound idea. I think we need to look at a cash flow position as well. So make them go hand in hand so that you can actually make the right decision. On the right-hand column there, you probably had a bit of time to look at that already, but that's actually investing in a property with no debt. So if one Tats Lotto, you've come into inheritance or you're lucky enough to have a couple of $100,000 sitting there and you want to buy property, you can see in that instance, without having to pay loan repayments or principal and interest, that property would actually return a profit of $10,000. And yes, you may have a marginal tax rate of assumed 25%, so there's a bit of tax there, but you'd be left with just over $8,000 in that instance. So that's a pretty sound investment. And cash flow per week, again, we break it down on that, you'd be actually pocketing $150 a week. So that could be a good example for someone looking to go into retirement and have an asset there that is actually going to fund their lifestyle or generate a return. So again, this isn't purely just tax focused, it's more strategic thinking, but it's about due diligence and crunching the numbers if you're looking at jumping into property, because you can see that there are differences in the numbers. So you just got to be careful of what you're assessing. Again, this is more strategic thinking. Again, this is a 25-year plan for someone who potentially wants to look at buying an investment property. Again, I'm using $300,000 as the example, but in this case, it's a pretty straightforward table. We outlay $300,000, and whether that's done by way of using bank money and loaning the money, or outlaying the 300 grand yourself, it doesn't really matter. If you were to have a desired capital return of 2%, and again, you need to do some research and due diligence on what that return is going to be, to see if it's sustainable or whether it's realistic. You can see that you can grow. So I've used 2% in this case because I suppose where we are based here, our return is 1.8%, history suggests. So I've used that, I've rounded up to 2% because it's just a round number. You can see if you could compound your property's return at 2% per year, year one, your property could potentially go up $6,000. But more importantly, we get down to the bottom, and that's when it starts going up by close to $10,000 per year. And there's a lot of elements to that. You need a growing population and demand for property, and a demand for property in that area too. So it's got to have services and education and facilities. But again, doing your research will help you make sure you pick the property in the right area. But if we use what history suggested as a 2%, a $300,000 investment now could be worth $500,000 in 25 years' time. So that's just the power of compounding. Again, you've probably got a tenant in there, they're paying it off. The operations might run out that it's break even, but this is the capital growth that you're exposed to by having an investment property. Again, I'm not quoting these numbers as real, but that is an example using historical averages of what could happen and what has happened in the past. So it's good to explore that idea anyway. But again, it's a pretty powerful little message to say, if you go and invest some money, this is where it can go. So that's part of the due diligence process if you're looking at investing, to really see where it can take you. With all this, and the bank will touch on this, if you're getting a loan for a property, make sure you haven't just got insurance covered on the building or the contents or the asset itself. You're probably your biggest asset, that you've got the ability to go out and earn income. If you look at that little green table down the bottom, whether it's life insurance or income protection insurance, that little green picture probably explains it all. If you earn 60 grand a year for 30 years, that's $1.8 million worth of earnings, sitting there ready to go. If you were in a car accident or you had health issues, that compromises your ability to earn. So if you don't have the right insurances in place, you really compromise what your investment opportunities are, or compromise the ability to service your investments. If you've got one and something goes wrong and you can't pay it off, then you're forced to sell. So I would really advise anyone that's hasn't looked at their superannuation or their insurance to actually sit down with a financial planner or their insurance agent and have a review of that, because it's extremely important. And if something was to happen to you, what does that leave behind for your family or for your kids? Because you want to be able to service your loans and your debt and leave something for the next generation too. So making sure there's enough insurance is highly important. All of this, anyone, I've seen people with investment properties that earn $30,000 a year, and I've seen people with investment properties that earn $200,000 a year. So anyone can do it. It's a matter of having a deposit there and enough equity and security behind you to get in and make it start. It's one of those things that it is a big leap of faith, but hopefully from the numbers that I've showed there, it's there can be some real benefits to it. That's what I try and advise people to do it in the most tax effective way, I suppose. So there's probably a lot unanswered in all of this that I didn't want to go too heavy from a tax point of view or a legislation point of view, but I think I touched on it earlier. I think surround yourself with a team. Now, whether that's family or friends to start the conversation, or your husband or your wife, it's a good conversation to start. And then from there, you can do your due diligence, like I said, and talk to real estate agents or accountants and advisors, your bank manager, mortgage broker, your property manager to start getting some information behind you and making the best informed decision you can. So it's all about being proactive, not reactive. I think if you can be proactive and be on the front foot and you're ready, and a good example would be, go to the bank and see how much you can borrow, because you never know when the perfect investment property comes up on the market. If you've got bank approval, in theory, you can go and make an offer on that property tomorrow and make sure that you get that property that come up that's getting a 7% return. That it might be a mortgagee option, or it might just be a deceased estate that someone's wanting to offload it. So you don't want to miss out on opportunities. So proactive is very important in that sense. That basically finishes me off for the day. I like this quote here, which is, if you don't find a way to make money while you sleep, you'll work until you die. So I'll leave that thought with you. But essentially, I suppose having a tenant there, they're paying your mortgage off for you, or if you don't have one, they're paying you to live under your roof. So have a think about that one. But that sort of concludes. I hope it's been really informative. Leah, thank you for having me. I'll throw back to you now if you've got any questions or anything you want to touch on.
Oh, thanks, Abe. So, well, as some people know, every year we do the Investors Nights. We normally have the top floor of the Cry Hotel booked out, and quite a few landlords or prospective landlords come down, and Abe is one of the speakers that normally comes along and helps out. Unfortunately, due to COVID-19, we can't book out the top floor of the Cry, and we can't speak to a lot of people face to face. So that's why we thought that we would do the presentation this way. But you're right, Abe, you do need the right people around you. I bought my little unit investment property. I bought that. I was working as a casual property manager at the time. I was also a single mum to 2 young kids. I'm pretty sure they were both still in primary school. So, if you do have the deposit, if you've got the equity there, or even, I think what really pushed it over with our application was the fact that I had the deposit there, but also the return was there. So they could definitely see that the rent was going to be able to cover virtually everything. And I mean, if you need to, we can always do up a appraisal letter for you as well. But Abe, how much time does it save you at the end of financial year, as you as an accountant, when a landlord just comes in and says, here's my end of financial year statement, because we as agents will do that for our landlords, as opposed to a landlord that comes in with the box full of monthly statements and the receipts and everything else?
That's a fantastic question, Leah. And I think any accountant out there that gets the shoebox or the box full of receipts probably cringes when they see that come through the door or through their office. So the annual statement has changed the way we do things, because we're not sitting there with clients, going through receipts or bank statements and things like that. And there's a lot of accountants out there will do, they will charge on an hourly basis. So I suppose if you want them to go through a shoebox for 2 hours, it's going to cost you more in your accounting fees for a simple task. It's administration, really. Like there's not much knowledge or skill that goes into sorting receipts. So having agents produce that sort of information allows us to enter an income figure with attached expenses. So sometimes that can have all the expenses from rates to insurances and repairs on there, or sometimes it's just the agent's fees deducted from that. But certainly need that to complete the return, and probably if they're with an agent, I'd be reluctant to complete the return without it, because there's a question of accuracy as well. Like if you're going through bank statements or a summary, which isn't from the agent, you question whether you've missed anything, which poses the question, is there an ATO audit risk? So highly important and very valuable to what we do, and saves us a lot of time, and in essence will then save the clients, I suppose, accounting fees as well.
Yeah, well, so I better start charging for that then. Also, you were talking about doing some repairs and the benefits of that with tax deductions. So if someone goes out and buys an investment property and it needs some repairs and things like that, when can they start putting this forward? So they haven't listed it for lease yet. There's not a tenant in the property. They've only just bought it. It's just settled. can they claim any of those repairs because they're getting it ready for a tenant?
Yeah, that's a really common occurrence too. And essentially, if you haven't produced income on the property yet, and you've just bought it, and day one you go in there and you start doing repairs or gutting things or any of that, they're actually deemed as capital expense items. So it's part of the cost base of the property to bring it up to a standard to then rent it out. So if that was the case, you'd be better off finding a tenant, or if there's already a tenant in there, leaving them in it. And if they're in there till the end of that lease period, whatever that may be, it could be 6 months, it could be 2 months, it could be 5 years. What you can do then is go in and do those repair jobs, or have some of those repairs done while they're in there. That's just maintenance of the property rather than the capital deduction. So it's probably a question that doesn't get asked, that should get asked, because most people, when they buy a property, that's the line in the sand to say, right, let's get in there and do some work. But you could go and spend $2,000 and it's deemed as a capital item. Whereas once the tenant's in there, or once you're deriving income, I suppose there's wear and tear on the property at that point in time. So you can sort of walk away from there and say it is a genuine repair, and that's how the ATO assesses it. So we can go in and claim a tax deduction and get a bit more tax refund or tax relief from what our tax bill was going to be in that sense.
Awesome. And just to throw it out there, what are some of the biggest tax deductions that you've seen on investment properties? So, it could be from maintenance to expenses to anything.
Yeah, so the big ticket items are always interest, because if you fund a property, the interest is always going to be, depending on what the rates are, but even with 3% rates, if it's a $200,000 loan, there's still $6,000 deduction. So it's always going to be one of the higher ticket items in there. Depreciation is a big one too. So whether it's installing air conditioners or things like that, you're going to get depreciation on that over a number of years. Or if you've bought a property, quantity surveyors will give you a report, so they'll advise how much depreciation is. So they're probably the two that jump out at you. Things like water rates, council rates, insurance, any of that is pretty standard, somewhere between $500 and $1,500 a year. So they're not huge ticket items. Sometimes you will see some big repair bills in there. And again, must stress that if we are doing repairs and it's not adding on a pergola or a deck or re-roofing can be a repair in some instances, it's just a matter of having the receipts worded right by the trade, if you're using a tradie, to say that it is a genuine repair. And if you go and a good example would be if you went and replaced a fence that had blown a portion of your back fence, say, had blown over, or all of your back fence had blown over, and it was just a genuine pine timber fence, and you replaced it with Colorbond, that's a capital depreciable item. Whereas if that back fence had blown over and you pushed it back up, or you went and got some new pine and sort of replaced it, there's more of an opportunity there to say that that's a repair, because it's not replacing every single fence in the property, it's repairing that asset and using the same materials. But when there's a significant change in the materials or the character of the asset, that's when repair is probably nearly off the table. So repairs can be genuine and big. It's probably more of an audit target the bigger they get. But again, if we've got the right substantiation requirements behind that, there's no limit on what we can claim. It's just got to be genuine.
Awesome. Well, thanks for that, Abe. And if anyone has any questions, they can either shoot me a email and I can forward it on to Abe, or they can contact Abe at Phillipsons Accounting and Financial Services. Thanks heaps for coming, Abe.
Thanks, Leah, and thanks for having me, and look forward to catching up next time when it might be upstairs at the Cry again.
Definitely. We'll be planning that one again next year.
Thanks.